Ladies and gentlemen, welcome to Target!
Target made headlines when it recently said that it will launch a paid membership program in early April. A bold move that many saw as an attempt to compete directly with other retail giants, Amazon and Walmart, and their services, Amazon Prime and Walmart Plus. But that's not all, as Target's stock jumped by a whopping 12% after it reported earnings that beat Wall Street's expectations.
I'm not fucking leaving!
Bulls are charging in, showing their confidence in Target's future. Now the question arises, should you join them and invest in Target stock? In this video, we're going to explore Target's new subscription service and see how it compares to Amazon's and Walmart. Then we'll walk you through Target's recent earnings so you can determine for yourself if Target stock is worth your money. Welcome back to PST Markets. Target is determined to increase customer loyalty by introducing Target Circle 360, its subscription-based program. This program will include a lot of perks, but the main one that everyone is talking about is free unlimited same-day delivery for orders over $35, in as little as 1 hour with no delivery fees. Additionally, the program will offer updates to Target's Circle credit card, which takes an extra 5% off customers' purchases, includes free 2-day shipping, and allows extra time to make returns. The program will cost $99 per year. But Target said that it will offer a discounted price of $49 per year as part of a promotion that starts from the program's launch and ends on the 18th of May. Along with that, the discount will continue to be offered to Target's credit card holders after that. With this subscription program, Target is set to follow in the footsteps of its competitors, Amazon and Walmart, who have turned membership fees into a source of significant revenues, meaning that if Target's subscription plan works out, the company could bring in a lot of money from it. For example, Amazon Prime generated $40.2 billion in revenue for Amazon in 2023, while Walmart Plus generated $2.6 billion for the company. Even though it's currently unclear how many people would sign up for Target's paid tier, the free Target Circle membership has more than 100 million members, according to the company. So even if just 10% of the free tier members sign up for the paid tier, that's 10 million people. And if they all pay $99 per year, that's an extra $990 million per year. While Amazon has an advantage because it's available in multiple countries worldwide, Target beats it when it comes to price because Amazon Prime costs $139 per year for perks like free 2-day delivery and access to Prime Video. But if people can pay less for Target and still get Prime Video for $8.99 per month, many customers might switch to save money. On the other hand, Walmart's Walmart Plus costs $98 per year, and it offers perks like free shipping, free grocery deliveries for orders of at least $35, and gas discounts. Walmart has not said how many people subscribe to Walmart Plus, but its CFO John David Rainey said on the company's earnings call in February that its membership continues to grow by double-digit percentages. In addition, Walmart's CEO Doug McMillon told investors in February that Walmart Plus members spend nearly twice as much as non-members and buy more over the course of a year. With Amazon Prime and Walmart Plus being so successful, it's no surprise that Target's CEO Brian Cornell said in a recent interview that the paid membership program will encourage customers to place more online orders with Target, and that the company did market research that showed that customers value delivery to their homes even as they use curbside pickup more frequently. Home deliveries in the new program will be powered by Shipt, a membership-based company that Target acquired in 2017 for $550 million, and Shipt works similarly to how other gig economy companies like DoorDash do by relying on independent contractors who receive the products and get them to customers' doors. Target Circle 360 is part of Target's larger plan to diversify its revenue streams amid weaker sales. But why is Target undertaking these efforts in the first place? To understand why Target is introducing this new service, we need to take a look at how the company's been doing recently. Even though the company's Q4 earnings and revenue beat the expectations of Wall Street analysts, they were still underwhelming as the company's comparable sales have declined 3 quarters in a row. And yet, the company's stock jumped 12% after these lackluster earnings, so why did that happen? If you were just looking at the surface numbers of Target's most recent earnings, you'd think that this was a pretty bad report from the company, as the company finished its first fiscal year declining sales since 2016, as comparable sales fell 4.4% in quarter 4. But if you actually take a step back to really take a look at Target, you'd see that the company actually saw very strong growth over the past few years, as it gained a lot of market share during the pandemic, as its revenue jumped from $77 billion in 2020 to $92 billion in 2021, and then to $104 billion in 2022. Unfortunately for Target, the company got careless after it saw its success during the pandemic years and ended up stocking up on inventory it couldn't sell effectively and failing to cope with the supply chain issues that were rife at that time. Now it seems like the company learned from its mistakes, and what's happening with Target right now is that the company is giving back some of the massive market share it acquired in the pandemic to return to normal. So this will likely end soon, and Target will go back to same-store sales growth sometime after quarter 1 or quarter 2 of this year. So we can say that the reason why the stock increased is because investors think that Target's profitability is finally stabilizing after several weak quarters. Also in quarter 4, revenue rose 1.7% to $31.9 billion, which beat the analyst's estimate of $31.35 billion. But that top-line gain can be credited to a quirk of the company's calendar, and it's that its fiscal quarter 4 and year included an extra week compared to 2022. Target also showed improvements in profitability after struggling with inventory mismanagement issues in earlier quarters, as its gross margin rose from 22.7% to 25.6% thanks to lower expenses related to freight and supply chain, and its operating margin also improved and went from 3.7% to 5.8%. As a result, the retailer finished the quarter with an EPS of $2.98, up 57% year-over-year, and way ahead of the estimated $2.40. The company's position could benefit even more when it introduces its subscription service, especially since it'll be taking away home delivery fees by dealing through Shipt, so it can easily rev up its e-commerce business, which is really needed since digital sales have declined every quarter for the past year and dropped 0.7% year-over-year in quarter 4. And the paid membership program isn't the only thing that Target is doing to keep its shoppers and compete with other retail giants. In fact, the company is relaunching its free Target Circle loyalty program and credit card to make them easier to use and more personalized. For example, members who are on the free program will have discounts automatically applied when they're shopping, rather than having to scan through deals on the app. With all of this in mind, is Target's stock a good investment now? Target is currently demonstrating that it can deliver solid profits even in times of weaker demand, and that resulted in investors applauding its better-than-expected results. Looking ahead, the company anticipates a 3% to 5% comparable sales decline in 2024's quarter 1 and an EPS in the range of $1.70 to $2.10, compared to its EPS of $2.05 in quarter 1 2023, and much worse than analysts' estimate of $2.09. While this guidance isn't really good, it's safe to say that more pessimism had been priced into the stock than was deserved. Still, the company must return to meaningful top-line growth, which will be critical for a full recovery in the stock price, and maybe the Target Circle 360, as well as the decline in inflation, will help it do that. So Target's stock might provide a great investment opportunity right now, especially before the launch of the subscription service. Additionally, if you're a dividend investor, then you should know that Target will likely raise its dividend soon, and it has a streak of dividend raises that's 52 years long. With improving fundamentals, it's almost guaranteed that Target will maintain its dividend streak this year. This would be an extremely welcome move, as the payout is already a comparatively high yielder at nearly 3%, which is more than double the average percentage on the S&P 500 index. Well, that is everything for now. What do you think? Will you be buying Target shares? Please let us know in the comments below. If you haven't, please subscribe and like this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.